Welcome, everyone, to the latest episode of The Blueprint, our series delving into the minds of people impacting our country and our world, including some of America's greatest business leaders. Through this series, we sit down with exceptional leaders from across the Rockefeller network to explore what drives their success, how they think, how they lead, and how they navigate the responsibilities that come with building enduring businesses. Today, we're pleased to have Ed Murphy, President and CEO of Empower, a leading provider of retirement services and wealth management that serves more than 19.5 million Americans. Under his leadership, Empower has undergone a significant transformation, scaling through strategic acquisitions, advancing its technology platform, and sharpening its focus on delivering better retirement outcomes for the individuals and families it serves. Welcome, Ed. It's great to have you here.
Good to be here. Thanks, Greg.
It'll be fun to go through all this. So there's a lot to talk about, but nonetheless, I still want to go all the way back to the beginning of your career. And I know you were a financial advisor at Merrill Lynch, which is part of the reason I raised this, because as you know, I still have a soft spot for the Merrill Lynch I grew up in. And then you also had senior leadership roles at Fidelity and then Putnam, of course, becoming the CEO, before becoming the CEO of Empower. So looking back at it all, what got you into financial services? Because it's been that industry, although multiple jobs, and now culminating in running this great business for so many years. But what got you started on financial services?
Well, I was a student at Boston College and was always intrigued with the financial markets. And I had this opportunity to take an unpaid internship at Merrill Lynch in Boston.
After which year? After
my sophomore year.
Sophomore year.
So I did that for 2 summers. And
did they pay you the second summer? Or
no.
No? Wow.
And then
put your time.
I approached the manager of the office at the time. And I said, look, I'd like to do this full time. And he said, we don't hire 23-year-olds out of school. You don't know anybody. You don't know anything. So we've never done this before. And I convinced him to hire me. And I ended up spending 7 years with Merrill.
Wow, I didn't know it was that long.
Yeah, it was a great experience. And then I left.
And you really got to understand the life of the advisor then too, right?
Absolutely. I mean, I worked courses so many advisors for about 1.5 years before I went off on my own.
Wow.
And what led me to make a change was the opportunity to manage people. So I went into a management program. I think I was 28 at the time.
At Fidelity?
Correct.
Yeah.
Yeah.
And did they headhunt you, or did you just decide? Yeah,
They
they
did,
did.
yeah.
So they called you, and then...
Yeah, at the time they had all these retail offices. They still do. They have
Yeah.
close to 200 offices now around the country. And they were looking for people with full service backgrounds to come in and create more of a business development type environment within these offices. They had been largely service centers.
Yeah. And in Boston, I mean, look, it's still a fantastic company. But in Boston at the time, it was dominant, right? Fidelity was like the place.
Absolutely.
Yeah.
Dominant today.
Dominant, still dominant today. It wasn't, no disrespect to them today,
Yeah.
but you know, in the 90s under Ned, it was really a rocket ship.
For sure.
So how long did you spend there?
Well, I was at Fidelity for 17 years.
Wow.
And the nice thing about that experience was they were very conscientious about moving people around the company,
Yeah.
and very intentional about that. So I spent several years on the retail side of the business. Then I spent about 5 years on the private equity side. Fidelity owns a lot of companies, some of which are
Fidelity, right? Yeah.
correct. They're wholly owned subsidiaries. And so I ran some of those companies, had oversight for others. And then I went back to the core business and focused on the institutional side, primarily the defined contribution side of the business, and did that for the balance of my time there.
Okay. And then Putnam called.
Then there was the opportunity to go to Putnam. Bob Reynolds had been the...
So that's when he went over to Putnam?
Yeah, he went over to Putnam. Well, Power Corporation bought Putnam in 2007, and they hired Bob in the summer of 2008. And so I started having conversations with him in the fall of 2008.
And did you knew Bob before this, from your Fidelity days?
Yeah, I knew him. I didn't know him well. I never actually worked for him at Fidelity. But this opportunity presented itself to come into Putnam and really take a kind of a fledgling business on the defined contribution side and really scale it and grow it. So that's what I did.
I mean, we're going to get to that. I mean,
Yeah.
what an incredible story now. But before we go there, I want to stay on the early chapter for a second. And I know you've got your children, some of them in the business, and you know some of young people. When you think about young people today, very different time than when you and I started, and you know, AI changing everything. What do you believe is the most important thing for them to focus on early in their careers today? What advice are you giving to the Murphy children and to other people?
Yeah. Well, I think first and foremost, and we both know this, I think we've had a similar experience, career progression isn't linear. right? Oftentimes,
Or predictable.
right.
You know, these people say, I'm going to do this and then this and then this. I say, you might do those things, but unlikely.
That's right. That's right. It's sort of that jungle gym analogy, right? It's not a ladder.
Yeah.
You know, it's lateral. You might take a step back or two. You know, what I really advise my own kids and others that I've spoken to about this is when you're young, is that's the time when you should be willing to take some risks. You know, move outside your comfort zone, do something that's fundamentally different, challenge yourself in a way that you don't think possible. We try to do that in Power. We identify people and we direct them into a new opportunity or present them with a new opportunity. And oftentimes the reaction is like, well, I've never run a P&L before, or I've never been on the distribution side of the business before. But these are people that we believe in. And I think at the end of the day, your value to an enterprise is far more impactful if you've had a series of different experiences. You know, it's the sum of those experiences. You know, building that portfolio, I think, that really sets you up for long-term success. So that's really, you know, what I encourage my kids to think about and other young people is, you know, be comfortable with ambiguity. I mean, sometimes you walk into a situation and it's not clear, and maybe the role definition isn't as tight as you might think it should be, but it's oftentimes what you make of it. And so that I think is the key. And I think embedded in all of this is just this curiosity, you know, this willingness to want to learn and to be curious and ask questions. To me, those are some of the characteristics that I think are really important for young people today.
Yeah, I agree. I think the pace of technological change and everything that's coming with AI makes those characteristics and those experiences even more important. Learning, dealing with ambiguity, because the world is changing so fast. The linear track is less and less available. And so I've been telling my kids and other young people, you know, find a great spot with great people and learn and stop worrying about trying to predict, you know, even 10 years ahead. Who can predict that now? Getting at a pace of change.
This is like Moore's Law on steroids.
Exactly.
What we're experiencing.
Yeah, and you and I have been at it for decades and decades, and this is the fastest Moore's Law on steroids we've ever seen.
Absolutely.
So let's come back to Empower, because it's an incredible name now, and what a job you've done building this company. It traces its roots back to 1891. I'm not even sure I was aware of that, with the creation of Great West Life Co. But the company today was officially formed much more recently in 2014. As you know, Rockefeller was 2018, so you and I are on a similar path there. And actually, our company traces its roots back to 1882 when John D. Rockefeller set up Rock & Co. So there's some similarities on both. But in 2014, the retirement business of Great West Life Co. acquired J.P. Morgan's retirement business, and this was off and running. We merged J.P. Morgan with Putnam and created Empower.
Right.
So talk a little bit about how that came together.
Yeah, we pulled the retirement business that I was running at Putnam out of Putnam, and we merged it with the Great West business in Denver, which was primarily...
So it was part of the rest of Putnam. It was pulled out. It was pulled because the Power Financial owned all of it. But you pulled it out, and then you merged it with...
We merged it with Great West in Denver, which was primarily a service provider to the small corporate defined contribution market and 457 government plans. They were sort of the market leader in the government space. We then acquired the J.P. Morgan business.
Right.
And that, when I reflect on the last 10 years or so, that was a seminal moment. That was really what I think is the sort of the genetic blueprint, if you will, for Empower, because it got us into a market that we previously were not in, primarily supporting large and mega S&P 500 type corporations.
It's Putnam and Great West Life were not really in.
Correct.
J.P. Morgan was.
That's right. And that needed to be successful because we bought the business, we moved those clients from the J.P. Morgan platform to our platform. We ended up investing about $150 million in the platform to support those clients and to add functionality. But we also had to earn the trust of the consulting community and those sponsors because we were new to that segment of the market and there were a lot of doubters. But the team really came through. It was a very successful integration. We retained about 70% of the revenue. And that, I think, really then set us up for success. And what I found is every time we've done an acquisition, we've actually seen a spike in organic growth.
Fantastic.
You know, it's sort of counterintuitive. People think, well, you're going to be distracted with a transaction. But actually, the opposite's been true. We've been growing faster after we've done deals, and we've done them successfully.
And part of the reason is you've done them successfully, and part of the reason is the deal has helped build the awareness of the brand and what you're doing.
Absolutely.
And that's led to some of the organic growth. So, and you came in as CEO around all of these events.
Right.
Right? They made you CEO when you put all this together in that deal, or slightly in advance.
Yeah, I was the president in 2014.
Okay.
And then Bob Reynolds was the CEO at the time, and then I became CEO in 2019.
Even as president, leading up to CEO, and I remember that time because I think I was on the board from 2016 on, but you were really driving it.
Yes.
You know, Bob, you were one of Bob's trusted lieutenants even while he was CEO and you were president. This vision, and you know, in the company, we're going to get to what the company is today, but the vision for the company, when did that start to come together? Was that when you stepped in 2014? Did you think this is what I want to build?
Well, I think pretty early on. I mean,
Okay.
if you think about the conversation we had about my experience at Merrill, and then what I witnessed and what I experienced at Fidelity, the goal was always to build a leading retirement and wealth management platform in the United States. That was always the goal. Obviously, the initial focus was really on the institutional side, building out the retirement capabilities, growing organically, growing through M&A. And then it was just, really about 6 years ago where we really started to emphasize the wealth management side of it, the mass affluent side of the business. And today that's a growing business for us, about 120 billion in assets.
Yeah, scaled already.
Yeah.
So when you were setting this vision out and you all were starting to really build this business, there were major competitors, including Fidelity, right? I mean,
Absolutely.
this was a very competed business at that time.
Right.
And you started, as maybe the 10th largest and then
Right.
8th. I mean, you really clawed your way into the position you are today.
For sure. And, at the time, we were one of the few real strategic acquirers.
Yeah.
And this market really doesn't lend itself to financial sponsors, right? Because it's really about being able to extract the synergies.
Yeah.
And the team that did the 2014-15 transaction, the JP Morgan transaction, that entire team is still with us at Empower. And they've worked on every successive transaction. And I'm sure we'll get into it, but we are going to continue to expand and grow through opportunistic M&A as we go forward.
And organic, both. They've
Correct.
both been. So maybe we'll talk about, first of all, tribute to your leadership, because I know that team's been in place. And I know, you have a great team and you handpicked them all over the place, and then there's a lot of consistency. But you've done a couple of very sizable acquisitions. You want to talk a little bit about those acquisitions and how you approach them, and once you start spending the kind of money you did and the scale of the businesses you're buying, the stakes of those deals are quite high. So, the risk return in your mind and how you thought about that. And
Right.
I did have a front row seat to watching you as the lead executive execute those deals.
Yeah. Well, I think there were really three, after the JP Morgan transaction, there were three others that were pretty significant. The Mass Mutual acquisition in 2020, the Prudential acquisition in 2021, where we bought their respective retirement businesses.
And give everybody listening some sense of the scale of those businesses.
They're both about $3.5 billion of enterprise value.
Yeah, and significant, the number of
Mass Mutual was 26,000
Yeah.
clients that we, on three different platforms that we imported into our system, one single platform. So a high degree of complexity, very, very technology centered type transactions. The Prudential transaction was also about $3.5 billion. And then we bought a digital hybrid wealth management platform in Redwood City called Personal Capital,
right in the middle of COVID.
right in the middle of
It
COVID.
was a gutsy move.
Yeah, I mean, all those three transactions were around COVID, where there was global uncertainty. And I think it's a testament to the board, which you're on, my board, but also Great-West Lifeco, the Desmarais family, and their belief in wanting to have a winning business in the United States. The fact that there was tremendous uncertainty, a lot of the M&A market had really grounded to a halt. And during that time, call it that 18-month period, we invested $8 billion of capital in three companies. And as you know, in most instances, M&A fails to deliver on the stated objectives, operational, financial objectives.
A high percentage of deal.
In our case, these were very, very successful on almost every level, whether it's revenue retention, whether it's achieving the cost synergies that we laid out in our plan. And so, and then of course, as I said, it really led to even accelerated organic growth when we successfully completed those transactions.
As you were doing the integration, what were the things that were highest on your list? And I have to say, looking back now, at all three integrations, but Mass Mutual and Prudential were the big scaled ones. The execution was terrific. I mean, it's still a business, so not everything went perfectly, but you had these objectives and this timetable, and you hit it a lot of the time.
Yeah.
What do you give credit? I mean, obviously your leadership, but
Yeah, I mean, I think, look, it's a great team. We've built a real muscle and discipline around this, but I also think from the very beginning, we put a premium on culture. None of these transactions were slash and burn. We brought over 1,850 employees from Prudential. We brought over about 1,800 employees from Mass Mutual. And our view was you need to win the hearts and minds of the employees before you can win the customers that are transitioning to our platform. And I think we represented a good off-ramp in some respects for those employees because they knew they were coming to a company that was well capitalized and that was very committed to the space that they're in.
that was determined to become a market leader. You were clear at that point.
That's exactly right. And so we really focused on making sure that onboarding process went well, that they felt welcome, that they felt like they could be a part of the future success of Empower. And that really then helps carry over to the conversations they're having with their customers. Because look, the Mass Mutual clients or the Prudential clients, in almost every instance, truly valued their relationship manager, the people they're interfacing with every day. So they're going to take direction in part from them. And so I think that's what led to the success we had. On both transactions, we retained 85% of the revenue.
Wow.
Which is pretty incredible in a hyper-competitive market.
Hyper-competitive scaled business. Those are there's great results.
Yeah.
I think very smart too to focus on the people the way that you did. And when I look back I advised on so many deals and I've been in some as principal. A lot of what goes wrong is around culture and integration and people. And for you to have that high on the list, that's a big part of. You've got to get the cost synergies, you've got to hit the timetables, you've got to consolidate systems, but if you don't get the cultural piece right, it's just not going to work.
The tendency is you over-index on the financial and operational metrics at the expense of the cultural dynamic.
Yeah.
And again, if you think about what the Demarest are trying to do and what Great-West Lifeco is trying to do, it's about building long-term sustainable businesses that are around for decades. And so this is a very labor-intensive business in the sense that, we're 13,000 people. Many of those people are facing off with clients every day. They're integral to our long-term success.
Yeah. It is great. The Demarest are, their orientation, as you know, they're a shareholder here as well, and the orientation is as very long term, and that's helpful. You got to build a business the right way over the long run. So I'd give all of our clients and those listening a sense of the scale today. So 13,000 employees. What did you start with?
It was much smaller than that, but today we're 13,000 employees. We're about $2 trillion in assets under administration.
Major player.
And
number of
20 million customers.
20 million. Wow.
Between our wealth business and our workplace business. And I was looking back on this, Greg, and again, I think this is a real testament to the team. If I look at the last 10 years, we grew earnings on a compounded annual basis after tax at 22% a year.
Fantastic.
So from 2014 to 2025, we grew earnings 750%. We quadrupled assets under administration, and we tripled our client base. So the challenge for the team now is to say, what got us to where we are today is not going to be what gets us to where we need to be 5 to 7 years from now. And so what do we need to do? We need to change, right? We need to be dynamic because the market's changing around us. And so it's making sure, as always, that people don't get complacent, that they focus on the prize and focus on execution. The good news is the team historically has executed really well.
Yes.
But we want to keep our foot on the gas and continue to bring value.
To the parallels, because we started in 2018 and we've had very successful growth and on all the metrics. And I'm very focused on the same topics you are, which is what got us here in the world of 2026. Given everything that's going on in that world, isn't going to carry us going forward. We need to pivot, adapt. On this day, as hungry as we were, just to start.
Historically, if you look back, this is what great companies do. They actually change when things are going well, right? They're looking introspectively. They're staying focused on the customer and what customer needs are and how customer needs are evolving, and being proactive and being sort of predictive around that as opposed to reactive, right? And that's, I think our role as leaders is to make sure that people are approaching the opportunity that way.
100%. Let's talk about the brand, because you've done an incredible job. I mean, Empower was a name you started with in 2014.
Yep.
But it was a niche firm at that point. And now we just heard all the statistics, 20 million customers. You've been working to get the brand out there. Talk
Right.
about some of the things you're doing to build the awareness of exactly what Empower does.
Right. Yeah, we have 19 million customers on the workplace side of our business, but many of those customers don't have an appreciation for the full breadth of our capabilities. They don't understand that we offer 529 plans, or that we're in the wealth management business, and that we can help them and help their families. And so we do want to build that direct connectivity, if you will, to the end user. So we've been very intentional about that. Back in 2019, we bought the naming rights to the stadium where the Denver Broncos play. It's called Empower Field at Mile High, and that's really been tremendous for us, both locally but nationally. We also have a pretty active advertising campaign. You know, we started off in 2022 running some ads, spent about $7 million in advertising in 2022, and that number's closer to $60 million now.
Wow. Yeah.
In traditional linear TV, live TV, we're doing more on social and podcasts and those types of things. And we're starting to see the needle move in terms of aided awareness, unaided awareness, and consideration, which is really important. We also moved pretty aggressively into golf, not sponsoring tournaments, but sponsoring players.
You've had some success with that.
Yeah, we just had Cam Young win the Players Championship. He wears our hat. He won the Players Championship, which is terrific. And then we recently launched a partnership with Stephen Ross in Miami for the Miami Grand Prix. So we're a sponsor of the Formula One race in Miami, which has, a hospitality component to it where we can bring clients, but also build some brand equity as well. So it's a work in progress,
Yeah.
but we're tracking it, and I feel like we're making progress.
Great. And the goal is, people have heard the name Empower, but you want them unaided to say, this is what they do.
That's right.
Yeah, that's
Exactly right.
Yeah. So let's talk about private markets and alternatives, which are a big part of what we do here. Our private advisors, our clients, as you know, are high net worth and ultra high net worth, and many of them should have a significant allocation to private markets alternatives because they can withstand the illiquidity of those instruments, and they can then benefit from the returns over time. So it's an increasing percentage of what our clients are invested in here. You've been pushing for those types of products to be available in a retirement context. Can you talk a little bit about how you see that?
Yeah, I mean, I think if you think historically, people investing in defined contribution or retirement have primarily been in stocks and bonds, unlike defined benefit plans and sovereign wealth funds and foundations and ultra wealthy who have had access to private market investing for decades with a lot of success. We've also seen that internationally with Canada Pension Fund, the superannuation in Australia. And so we came out pretty early on this. I've been pretty outspoken about the democratization of alts. I think the investing horizon tends to align pretty well with the typical retirement investor, where the monies are typically going to be there 25 to 30, 35 years. You have some of the best performing asset classes, but yet you have 140 million Americans that, heretofore have had no access. It just doesn't seem right.
Yeah.
And everybody says, well, geez, alternatives are risky. I would say concentration is risky. I would say an S&P 500 index fund where 45% of the return is coming from 7 stocks is risky. And then let's talk about just the structural dynamics of the United States. The fact that you have 50% less publicly traded companies today than you did in 2002. Companies are staying private longer. A disproportionate of the innovation is happening in small companies. This is the innovation market of the world, the United States. 90% of companies with revenues under 100 million are private. And so there's this asset class where you have tremendous innovation, tremendous growth, and yet we have 140 million investors that don't have access. So let's provide access, and let's do it in a way that's prudent and thoughtful, where we can address the concerns like liquidity and fees. And frankly, we can do that. So we launched a program. We have several firms that have joined up as partners, from Goldman Sachs to Apollo to Blackstone to Partners Group to PIMCO. among others, Sagard, and we're working with them to bring creative, diversified solutions to market. We're hopeful that we're going to get some support from the Treasury and from the Trump administration, some guidance for sponsors that would give them some comfort around making these products available, particularly if they follow the right level of suitability and care and standards with which they make selections. And so, I think we're waiting for that direction. I think it's going to take time, Greg, but if you said to me, where do I think the private market opportunity, what does it consist of 10 years from now or 8 years from now? I think 20% of the assets will be in private market investing, possibly more 10 years from now. And that's going from zero to call it $5 trillion. So that's a big up.
Look, you make the case very well, and it's a strong case. The private markets, I had somebody do the work on this for me recently. Private markets today are $20 trillion, and that excludes direct investments into private companies. So, 20 years ago, 25 years ago, it was mostly private equity, and now you have infrastructure, and you have private credit, and real estate, and all these different asset classes. And if you're just investing in public markets, that's $20 trillion that you don't have access to. That'll probably be $40 trillion, in another 7 or 10 years. So I do think you make a great case. I would assume it gets some traction, because again, in the way that you presented it, where you're protecting for making sure that they're suitable, and you're focused on the liquidity and making sure the illiquidity isn't in the wrong hands and fees. It's a huge
and I'm
not for those 150.
Yeah, and I should know a couple things. First of all, we have 300 clients that are in some form of implementation right now. It's not being structured as a standalone investment. So it's part of think about it as a collective investment trust, a multi-asset class. So you actually have liquidity within the product itself, and then you have liquidity outside, because we're recommending that people don't put in more than 20% of their available balance. So
the structure includes things that are liquid.
Correct.
Yeah.
Correct.
Yeah. Smart.
Yeah.
Shifting gears a little bit, but we're talking, you've got this huge wealth transfer coming. Mm-hmm. Baby boomers leaving money to their children. And you have Americans moving from saving to spending in retirement. How are you helping clients navigate major trends like this?
Well, so our typical client, I would characterize as more in the mass affluent space. So, what we're doing, I mean, their needs are going to be a little bit different than the ultra wealthy for sure. But what we're doing is, through retirement planning, through general advice, we're helping them sort of think through how to manage existing portfolios, but also as it relates to beneficiaries, whether it's children, extending that reach beyond just the individual. So it's a household approach, I guess, is what I would say. And the way we approach that is through a thoughtful discovery process, right, where we're learning about, their personal situation, what their objectives are, so that we have a view into, their entire situation, right? And increasingly what I'm seeing, Greg, is this convergence between retirement and wealth, where clients are looking for a more holistic approach. Whether you have $200,000 invest or 10 million to invest, there's value in sort of this end-to-end approach that looks at things from a holistic standpoint, as opposed to, this is my brokerage account, this is my defined contribution account, this is my pension plan.
Right.
And I think that, particularly in the mass affluent space, I'm not sure that anybody's really brought all of those elements together in a way that's connected and seamless and integrated, if you will.
This is where you're building your wealth business.
Correct.
Provide.
That's right. I think in the ultra high net worth space, it's done very well.
Yeah, that's what we do.
Exactly.
But I agree with you. I think mass affluent, there's an opportunity for you, as we talked about. We need to make sure we get into this conversation AI.
Yeah.
Given that everybody you and I talk to, not just Empower and Rockefeller, but every CEO that we both know is focused on the impact of these tools on their business and their business model. And the speed with which it's coming, I've seen the debate myself change a little bit in the last 3 months. Mm-hmm. When you see a company like Anthropic is doing a lot of work for clients that hire them to help build agents to make them more productive, which might mean that the agents are actually replacing some of the workers in the company. So the speed is increasing. It's no longer just about productivity, but maybe, wait, do I have to make shifts in my business model? How does AI impact this incredible company that you built and scaled now with 20 million end clients, 13,000 employees, $2 trillion in assets? The scale is tremendous. How are you going to fit AI into that and the changes that AI bring?
I mean, I think of AI as almost like an operating system, right? It's gonna reshape every business process. And I'd say if you go back a couple of years ago, we started out focused primarily internally as we thought about deploying some of the use cases. So, for instance, application development. We spend 2 million hours developing code, and in our 2025 budget, our technology team signed up for a 25% lift in productivity. So we didn't terminate 25% of the developers. What we did is we drove more throughput.
Yeah.
We got more projects completed.
Because they were using AI tools.
Correct.
Yes.
Another example is, knowledge management. Our business is very technical. The types of questions that you get from customers can be very technical. And so this ability to get people up to speed, particularly newer employees, where they can access a knowledge management system is very compelling. And obviously it's a win for the client because it reduces cycle time. First call resolution is faster. So we've deployed it there. We're deploying in our contact center. So we're more focused now on taking AI and applying it externally in a way that we can bring real value to our clients, whether it's the sponsor or whether it's the individual investor. And as I think about AI, and I think about it from an advisory standpoint. We talked about our backgrounds. I see it enhancing and enriching the advisor experience, rather than eliminating it, right?
Yeah.
Like and I also think advisors who adopt AI and leverage the technology, they're going to be the ones that replace the advisors who don't. That's my view. And then when I look at my business, our wealth business, call it 600,000 customers. I mean, the ability to leverage a digital coach and leverage AI to be able to put together customized portfolios, to be able to deliver tailored advice, bespoke advice at that scale, you couldn't do that with a human advisory team alone, right? So AI is going to provide significant lift there. So I'm pretty sanguine about it. I think that the opportunity is immense.
Yeah, we do too. And here, the example I've been giving, and this is a simplistic summary, but it's on point with where we're going here. We're building tools that we can use across the firm, but we're also building tools that advisor teams can use to interface with clients and to make everything they do more productive. But if we have a team that has 20 clients, $100 million each, that they're managing a $2 billion book with 5 people, in a couple of years, they may be able to do 40 families, $100 million each, a $4 billion book with 5 people.
Exactly.
Because of the tool. So that's the way we keep talking about it internally.
Yeah, it's going to, if deployed correctly, it should give you greater capacity to be able to do more. And I think it leads to much deeper, richer conversations and consultations with clients, because a lot of the things that were previously done, in some cases manually, are now essentially all either automated or they've been removed altogether.
Yeah.
So you take the friction out and you focus on what people really value, which is advice.
Yeah.
So I think one of the things you and I both believe is that the value of advice will be powered by technology, but at the end of the day, particularly in volatile times, whether you have 30,000 to invest or 2 million to invest or 10 million to invest, you want access to a human being. Every single survey we've done at Empower, at all income cohorts and portfolio cohorts, suggests that is in fact true. The hybrid model is the one that ultimately.
I'm 100% with that. I mean, the front end and the client interface is going to stay human interaction here in our business.
Absolutely.
And I think it's the same thing with you. Yeah. So let's talk a little bit.
I think it's your greatest asset.
I do too.
Yeah.
I mean, it is. Before we close, let's go back, because they've been such a key part of your life and now mine, the Demery family and the long-term investors. They've been in here since 23. They've been with you since 14. They were in Putnam early. They no longer have Putnam, but they've got this business, which came out of Putnam,
Right.
one of the real huge success parts of that story. They're great long-term investors. Talk about how they fit in from your vantage point and and the interplay you have there.
Yeah, it's been a phenomenal experience for me. It's well, first and foremost, the integrity is unmatched, right? And high integrity, the passion and drive to win. You know, Andre Desmarais said to me one time, we want to be one or two in every business that we compete in. And we always wanted a winning business in the U.S. because it's the greatest country on earth. And we feel like we have one in Empower. So I carry that burden pretty heavily, right?
Oh, you've done pretty well carrying that burden so far.
Right. But, what I find is that they're very engaged. They know the business, but they let my team and I run the company. And I think you see the same thing. And, we've earned the trust, we've earned the credibility. They're there to support, to wave the flag. And as we talked about earlier, they gave the Empower team $8 billion of capital at a time when
A lot of
there
it's
was tremendous uncertainty. And I'll always remember that. And so they're terrific to work for. And it's a great family. And by the way, we roll up through a publicly traded entity, so we do, we have quarterly earnings. But they do take a very long-term approach.
Yeah.
And what I have found is if my team and I go to the board and we put forward a compelling idea, even if that's an idea that would take down earnings and maybe even impact the dividend, but the long-term implications are meaningful and the value we can provide to clients is substantial, they're supportive.
Yeah.
Which I think says that they're not near-term focused. They're really thinking about.
I mean, I've been in some of those conversations, and the same thing with us. They were the first outside shareholder I brought in here, because I had the relationship with Paul way back to the Merrill Lynch days, and I'd gotten to know Andre, and I really wanted them because they are so long-term in orientation, and that was in 2023, and that really set us up for the second recapitalization in 2025, and the fact that the Desmarais are such respected long-term investors was part of the attraction for some of the new families I brought in. The Moose family knew the Desmarais. Hemingway, knew of the Desmarais. David Abrams. So it's, they've been a draw for me in that.
Sterling reputation.
Yeah, sterling.
Worldwide.
So I've got one final question for you. You've led Empower through times of great transformation, is the phrase I'm looking at there. But it's actually, the phrase I would use is through thick and thin, wherever that comes from. Because you started in 2014. Think about the volatility that you've managed, from that time with Empower, including COVID, where you led, frankly, brilliant acquisitions to create differentiated scale at a time when many were out of the M&A market. So what success stories, and we should say success stories, not lessons, because you created this entity. You were a huge part of it. What success stories do you pull out of that? What were some of the things that enabled you to have the trajectory that you've had? I think it's a perfect way to end because it's an incredible success story. And I know it makes you uneasy given the nature of you. You're like, wait, I've got more to do. I know you have more to do. But, this company really came out of whole cloth 12 years ago. And it's, a company with 13,000 employees and 20,000 clients and $2 trillion of assets. And it didn't exist in 2013. So what are the things that you point to?
Well, I mean, we talked about a couple. I keep coming back to culture.
Yeah.
And building a team of, people who are motivated, inspired, understand the mission and the vision. Our mission is financial freedom for all. We have a core set of values that we reinforce every day.
It's a great phrase.
And we're not, we don't discriminate. It's financial freedom for all, right?
Yeah.
And so we rally around that. We rally around this theme of clients for life. Right? You might come in through the workplace, but we really want you to stay with us for life. And we know we have to earn your trust and earn your relationship over time. But that's the way the organization thinks about it. I think we try to put a focus on execution. I mean, strategy matters, but execution matters more. Because strategy morphs, and you're oftentimes responding or reacting to changes in market conditions. So the strategy iterates over time. But it's really all about the execution, right? And staying focused on that prize and staying focused on execution and delivery. And also, I would say, is, complacency is a killer. it kills businesses, right? So that's the one thing I stay focused on with my team, is that they're not complacent. And as we get bigger, and you know, the companies are much larger than we are, but at 13,000 people and 90,000 institutional clients and 20 million investors, I don't want us to get insular in our thinking. We have to continue to put the customer at the center of everything we do, outside in approach. And sometimes we drift from that. And so I think it's incumbent upon me and other leaders in the organization to make sure that we stay focused on delivering value for the client. Clients have choices.
You know, I'm thrilled that I asked that question as the last question, because I'm thrilled with that answer. It's fantastic. And I want everybody who's listening from a Rockefeller standpoint on my team, execution is everything.
It's everything.
And then a lack of complacency. And the greatest companies in history have always been, not been willing, have always pivoted in response to changes in the exogenous world.
Exactly.
And you have that mindset, and I have that mindset. And the success that we both enjoyed to this point goes away and is elusive unless you hold on to that mindset and you continue to relentlessly focus on execution and not be complacent.
There's all these external factors, like we face them all the time, geopolitical. You just focus on what you can control. 50% of our revenue goes up and down with the market every day. It's asset-based. I can't control that.
Yeah.
But what I can control is our actions and how we're delivering for the customer every day. That's what you focus on.
Well, bravo, Ed. It's been a great story. Thank you for being here today. I really appreciated having with, and I'm happy that all of our clients and
Thank you for being such a great board member too.
great. Well, it's been a great ride to be on. You know, from the beginning, seeing all this. So, congratulations. Thanks for being here. Ed, thank you for joining us and for sharing your perspective on leadership, scale, and the future of the retirement industry. To our listeners, thank you for joining us for another episode of The Blueprint. And we hope you'll take time to visit our growing library of insights from those building and leading remarkable American brands and businesses.